Welcome to the PJ Finance Show.
Today we will talk about lessons from the Great Financial Crisis. Good morning, Phoebe. How was your weekend?
Oh, I didn't do anything special. Tell me about your weekend though.
To be honest, it wasn't too great. I was burying myself into these documents but couldn't come up with a clear conclusion. Almost went into a burnt out.
Why don't you show me? I might be able to help. Allow me to do a quick sum up about QE, quantitative easing. Basically, QE is about the Fed buying bonds, interest rate falls, stocks and home prices increases. There is also a wealth effect where people would feel richer, hence more consumption happens. With the Fed printing more dollars, this means a greater supply of dollars will weaken the dollar. A weaker dollar can make U.S. exporters more competitive, hence increasing U.S. exports. All of these, in theory, of course.
If I'm not wrong, these will create a stronger economy, as well as more jobs.
Correct. However, when we look at the details beneath it, we can see that the stock market became extremely addicted to QE. QE1 coincided with a stronger stock market. Then the Fed came in with QE2. The stock market rallied until the end of QE2. The stock market sold off.
It is unhealthy because the stock should operate in a free market and moves up or down based on supply and demand from private investors. This in turn depends on corporate earnings, and investors' optimism or pessimism.
We have discussed this in E4 stock valuation PE multiple method.
Yes, moving back to what I mentioned before, the money printed by the Fed. As this chart shows, the total reserve increased significantly but the required reserve did not grow much.
What is the difference between total reserve and required reserve?
It's the excess reserve. Excess reserve is the money that a bank keeps on hand when there are no loans. Think of how the money printed by the Fed goes into the bank and just lie there in the vault. So, the bulk of the new money did not get into the economy for consumption, investment, yada yada.
From the U.S. bank loan growth, I can see that there is a sharp contraction followed by a recovery during 2009 to 2012. Subsequently, loan growth was very weak.
Yes, and the velocity of money didn't grow.
We covered this MV equals PT in MP1 transmission and limitations of monetary policy.
Aside from the people who owned stocks, who had benefited the most from this?
Surprisingly, it is the government. It's because they're net borrowers, they issue bonds. When interest rates on these bonds have decreased, they are paying less, which is a great situation for them.
So, who will be at the loss then?
It would be the people who lend money to the government. In the case of the U.S., the central government benefited from the improvement in their net interest income, while the group that has suffered would be the insurance and pensions fund, households and the rest of the world. I also want to talk about the cost-benefit of quantitative easing.
In the beginning, when the economy crashed, the QE was justified.
Yes, then the Fed was able to take out the uncertainty premia by lowering interest rates and create the wealth effect on consumption as I mentioned before. However, as the effect continues with more QE over time, then the marginal effect turns negative, pulling down the overall cumulative benefit.
More and more QE distorted asset allocation. When interest rates are very low, people are forced to invest in riskier assets, and it also encourages companies to borrow money to buy back their stocks, hence this has distorted incentives.
Long-term investors like pension funds will also have deficits because their liabilities are fixed while their income-generating assets are receiving less. In addition, since it is the rich who own more stocks and bonds, the gap between the rich and the poor widens. It also creates more inequality.
I see. When interest rates are lower, the bank profitability also becomes a major concern. In addition, it doesn't only distort incentive but it also encourages leverage, which includes borrowing money to speculate in the stock market.
Correct. As we all know, having increasing leverage is not a good thing for a country because it could lead to an asset bubble. When an asset bubble bursts, monetary policy can become ineffective.
We discussed this in MP2 lessons from Japan.
Now that we sum it up like this, I do get a clearer picture of how QE works. Thanks a lot for helping, Phoebe.
You're most welcome as always. Thank you for watching.
This presentation on lessons from the Great Financial Crisis is brought to you by the PJ Finance Show.